Welcome back, Plutus people. Today we'll be talking about a Greek that will help you understand the value of time. Time is valuable in life in general, but stock market, like all other things that are good, teaches you the value of time and patience. But what's interesting about Theta is that time is not your friend. So patience might not be your best friend in this case. And today we'll be looking at how you can harness the power of Theta to sell calls and also be cognizant of Theta decay when you hold an option contract so you don't lose money. So what is Theta? Theta measures the impact of time decay on the value of an option contract or its premium. So time is not on your side when you open up a position. So let's say you buy a call option or a put option, time is always running away from you because you have a set expiry date that you have said that at this expiry date, the strike price, at this strike price, the underlying will reach that strike price or be far away from that strike price. As time goes on, as time nears expiry, the time decay accelerates because the chance of that option ending up in the money lessens and lessens. So that's how Theta is really important to the value of your option contract. We're going to explain this better by using Theta in an example. What's also important about Theta is that it's always negative for an option contract. Remember when we were talking about delta and how it could be positive or negative, but Theta can only be negative because time only moves in one direction. Time is decreasing, it's passing. You can't go back in time. I wish I could go back in time for some of my option plays, but you can't, and Theta is running away from you. So let's put this into context and use Theta to apply Theta to an options contract to understand it better. So let's say you are very smooth-brained. This is a term used by Wall Street bets, and you pick up an option for a ticker name SPY. SPY is S&P 500 most actively traded ETF. So we'll say we're picking up the ticker SPY and we're predicting that it will reach 420 because that's a special number by 420. So by 20th of April, SPY will end up higher than 420. If you look at the Theta value when you purchased that contract 3 months ago, so this is expiring in April, you bought it in January. So there's about 4 months remaining in this options contract. So the Theta initially would be somewhere like minus 20. So what that means is that if the option has no intrinsic value, like let's say SPY was trading at 400, so your bet is out of the money, it does not have any intrinsic value, the extrinsic value or the time remaining, because it's almost like you're predicting in the future, you're hoping that it will go to 420. So that's an extrinsic value because you're speculating. People who have to buy this option contract from you give it an extrinsic value based on implied volatility. Implied volatility is another term I'm introducing here because it's very important to understand the value of an option contract. Intrinsic value essentially means what the market is pricing in terms of a future move. So let's say an earning report is coming up. The SPY has no earning because it's an ETF, but let's say an earning report was coming out in March. The option contract's implied volatility will go up as it reaches a binary event because either the earnings could be good or bad, affecting your option premium, your chance of ending up in the money or greater than 420. So implied volatility does impact Theta. If your implied volatility is high, then your Theta will also be high. It gets impacted. So let's go back to our example. You're predicting SPY will end up at 420. It's trading at $400 right now. Your Theta, when there's enough time period that this can happen, your Theta will be about 20. So let's say every day that passes, your option contract would lose $20 in this hypothetical situation. If it's not moving in your direction, in your predictability, you said it will go to 420, let's say it went down to 390, your option premium is going down. Think of Theta as a way of transferring money from option seller to option buyer. So if you want to be Theta gang, like you want to sell calls, Theta is your friend, but if you want to buy calls, Theta is your enemy. So going back to our example, let's say you reach March, there's only 1 month left in the expiry of your contract, and it's $405. It hasn't reached 420. Your Theta, it's this rate of change of Theta will accelerate, and your option premium will start going down faster, so solely based on Theta. And the reason for that is because there's a less chance of this option contract ending up in the money. There's a less chance of this event happening that it will be higher than 420. So time decay is not on your side. It's time for your favorite segment, ticker of the week. How can we not do MVIS or Microvision, since it is the new GameStop? Because Wall Street Bets is all hyped about MVIS. People started buying this when it was for a few cents, and actually I regret it to this day because I had a shit ton of MVIS at 20 cents a piece, and I thought that this was a stupid penny stock that I didn't even want to be in, and I sold it for a small profit. But if I had held those shares by now, it's trading at what, $15-16 a buck today, even with going down. But you have to be careful. It's one of those meme stocks that you can get burnt by. But if you break it down and see at Microvision as a company, they talk about the LiDAR sensor, and there's a lot of exciting new products that are coming out. With any meme stock, the fundamentals are kind of clouded. So it's important that you do your due diligence and leave the comments below and tell us, is MVIS a solid purchase, or is it something that is a fad and it's going to fade away? But we'll see going forward. It is showing potential for people who have held it from 20 cents, and from a purely money-making point of view, I think it has some potential still left in it for another squeeze. So as always, do your own due diligence, but look at MVIS.